Your bank meets every federal requirement by keeping your funds accessible and insured up to $250,000 through the FDIC. What your bank does not do, what no bank in America is legally obligated to do, is inform you when your account activity generates a federal report that reaches an IRS analyst's desk within 72 hours. That is the system as it was deliberately constructed. And in March 2026, the IRS modified the parameters of that system in a way that affects an estimated 24 million Americans over the age of 60, without issuing a single press release, without sending a single notification letter, and without changing a single word on your bank's website. Donald Yates, 73, from Clearwater, Florida, deposited $6,200 into his Chase checking account on April 3, 2026. It was a routine transaction. The money came from selling a used fishing boat to his neighbor. 11 days later, Donald received IRS Notice CP-2000 requesting documentation of the deposit's origin and its connection to his reported 2025 income. Donald had never received a letter from the IRS in 48 years of filing returns. He phoned his accountant in a panic. His accountant told him something Donald still struggles to accept, that the deposit itself was not what triggered the notice. What triggered it was the pattern. Here is what changed. Before March 2026, IRS monitoring under the Bank Secrecy Act focused almost entirely on the $10,000 currency transaction report threshold. That threshold still exists. Any cash transaction exceeding $10,000 still generates a CTR filed by your bank with FinCEN. That has not changed. What changed is how the IRS cross-references CTR data with a second, lesser-known reporting mechanism: suspicious activity reports, known internally as SARs, under 31 CFR Section 1020.320. Your bank is required to file a SAR on any transaction, regardless of amount, that the bank considers unusual relative to your established account pattern. And in March 2026, the IRS issued updated guidance to financial institutions through FinCEN Advisory FIN-2026-A3, effectively lowering the practical threshold at which banks are expected to evaluate transactions for SAR filing. If you are over 65, receiving Social Security deposits, occasional pension payments, or irregular income from part-time work or asset sales, what I am about to explain over the next 20 minutes could prevent a letter you absolutely do not want to receive. And later in this video, I will show you the exact account structure that tax attorneys are recommending to their own parents, a structure the IRS has no objection to, but that most seniors have never been told about. The first thing you need to understand is what the word unusual actually means to your bank's compliance department, because it does not mean what you likely assume. Your bank is not concerned about large deposits in isolation. Your bank is concerned about deposits that deviate from your established baseline pattern by more than a certain percentage. Before March 2026, most major banks set that internal deviation threshold at 50% above your rolling 6-month average. The updated FinCEN advisory did not mandate a specific new percentage. And this is where things become murky, because some compliance officers I have spoken with report that their banks shifted to 30%, while others maintain that nothing changed at their institution. The ambiguity itself is part of the problem. What this means in practical terms: if your checking account receives an average of $3,400 per month from Social Security and pension combined, and you suddenly deposit $6,800 in a single month, even from entirely legitimate sources, your bank's automated compliance system may flag that account for SAR review. The SAR does not mean you did anything wrong. It does not mean you are being audited. It means a report now exists bearing your name, your account number, and the specific transaction details. And that report is accessible to IRS Criminal Investigation, the FBI, and FinCEN for 5 years. Raymond Cross, 69, from Tulsa, Oklahoma, sold his late mother's furniture on Facebook Marketplace across 3 weekends in February 2026. Total proceeds: $8,900, deposited in 3 separate amounts of $3,200, $2,800, and $2,900. Raymond did not know that depositing money in multiple smaller increments rather than one combined sum is precisely what activates the second layer of scrutiny. The IRS refers to this as structuring, defined under 31 U.S.C. Section 5324, and it is a federal offense even when the underlying money is completely lawful. Raymond was not charged, but a SAR was filed. And when he applied for a home equity loan 4 months later, the bank's internal review identified the SAR and denied the application. No explanation was provided. No appeal was offered. I am curious, have you ever divided a deposit into smaller amounts because you believed it would draw less attention? Based on what viewers shared with me after the last video, at least 40% of you have done this at some point. And every single one of those divided deposits may have generated more scrutiny than one larger deposit would have. If that describes your situation, type the word split in the comments because the number of people who do not realize this is genuinely staggering. The second thing you need to understand is the distinction between the $10,000 CTR threshold and the practical SAR threshold, because confusing these two is the mistake that puts seniors at risk. The CTR threshold is fixed. It is $10,000. It is automatic. Your bank files it regardless of circumstances. You cannot avoid it and you should not attempt to. The SAR threshold is variable. It depends on your bank, your account history, and the compliance officer reviewing your file. Some banks internally apply $5,000 as a SAR review trigger for accounts with low average balances. Others use $3,000 for accounts that primarily receive government benefit deposits. The IRS has never publicly confirmed these figures, but former compliance officers from 3 major banks have described these thresholds in sworn testimony during federal cases between 2019 and 2024. And it gets worse. The March 2026 FinCEN advisory also expanded what qualifies as a reportable pattern. Previously, a pattern referred to multiple transactions within a short time frame that appeared designed to avoid the $10,000 CTR. Now, the advisory explicitly includes rapid balance changes inconsistent with account history and multiple deposits from non-recurring sources within a 30-day period. That second phrase, non-recurring sources, is what catches retirees. If you sell a vehicle, receive a gift from a family member, cash out a small CD, and deposit a refund check all within the same month, that constitutes 4 non-recurring deposits in 30 days. Each one individually appears unremarkable. Together, they form a pattern that the updated advisory explicitly identifies for review. Everything I just described about CTRs, SARs, and pattern detection. There is a structural vulnerability in this system that the IRS does not publicize, but that works entirely in your favor once you understand it. And it connects directly to what tax attorneys are quietly advising their most valued clients. I will get to that in 4 minutes, but first I need to address the myth currently circulating online, the one that is causing more confusion than the actual rule changes. If anything I just said has caused you to reconsider how you manage your deposits, and based on the messages I have received this month, it should. Hitting the like button takes 2 seconds and signals the algorithm to share this video with other seniors who are about to make the same error Raymond made. 2 seconds. That is all it takes to potentially protect someone else from losing a loan approval over a furniture sale. The myth goes like this. The IRS established a new $600 reporting threshold for bank accounts. You have likely encountered this claim on social media, in forwarded emails, and across dozens of YouTube videos. Here is the precise truth. In 2021, the Biden administration proposed, as part of the Build Back Better framework, that banks report aggregate annual inflows and outflows for accounts with more than $600 in total activity. That proposal was never passed. It was rejected in the Senate in 2022. It was never signed into law. It is not in effect. No bank reports your account to the IRS simply because it holds $600. That is misinformation. However, and this distinction is critically important, the failure of that proposal did not prevent the IRS from achieving a comparable surveillance capability through the existing SAR and CTR infrastructure. The March 2026 FinCEN advisory accomplished through regulatory guidance what Congress declined to accomplish through legislation. A different mechanism, but an overlapping outcome. Karen Alrek, a CPA based in Phoenix who spent 19 years as an IRS revenue agent before entering private practice, framed it to me this way. The $600 threshold is gone, but the SAR expansion achieves roughly 80% of what that threshold would have accomplished, without requiring congressional approval. It moved through FinCEN as an administrative update, no vote required. So what does this mean for your checking account right now in July 2026? It means 3 things. First, the amount of money sitting in your checking account matters less than the pattern of activity within that account. A senior with $50,000 in a checking account who receives identical deposits every month and makes consistent withdrawals will never trigger a SAR. A senior with $4,000 in a checking account who receives 3 irregular deposits in a single month might. Second, the number of accounts you hold and how funds move between them is now visible in ways it was not before 2026. Transfers between your own accounts at the same institution do not trigger SARs. Transfers between accounts at different banks can if the amounts exceed your historical pattern. Third, cash transactions remain the highest scrutiny category. Electronic deposits from recognized sources, your employer, the SSA, your pension provider, carry the lowest risk profile because their origin is pre-verified. This next part causes many people to disengage because it sounds technical. Do not let that happen. This 2-minute explanation is the difference between understanding how the system operates and being blindsided by it. The IRS uses something called a DIF score, discriminant information function. Your tax return receives a DIF score annually. What most people do not know is that since 2024, IRS-CID, the Criminal Investigation Division, has been incorporating SAR data into a parallel scoring model for individual taxpayers. This means your bank activity now independently influences your audit probability, separate from what appears on your tax return. A return that would otherwise score below the audit threshold can be elevated above it by SAR filings connected to your Social Security number. The IRS has not publicly announced this integration, but it was described in detail in a 2024 Government Accountability Office report GAO-24-106-231 DAO on pages 47 through 53. If you have stayed with me this far, you are clearly someone who refuses to be caught off guard by rules that shift without warning. Subscribing ensures you will see the follow-up video I am releasing next Thursday on the 3 specific IRS letters that precede a bank-related audit and exactly what to do on the morning you receive one. That video connects directly to everything we are covering right now. Now, the account structure that tax attorneys are using for their own families. This is not exotic, it is not aggressive, it is straightforward, entirely legal, and designed to sustain a stable pattern that never activates automated review. The structure has 3 tiers. Tier 1, a primary checking account that receives only recurring, verified income, Social Security, pension, annuity payments. Nothing else enters this account. No gifts, no sale proceeds, no refund checks. This account maintains a flat, predictable pattern that automated systems recognize as baseline normal. Tier 2, a secondary account. Many attorneys recommend placing this at a separate institution, designated specifically for non-recurring deposits. This is where your boat sale proceeds go. This is where birthday money from your daughter goes. This is where your CD maturation gets deposited because this account is expected to carry irregular deposits. Irregular activity does not deviate from its own established pattern. Tier 3, a savings or money market account functioning as a buffer. You move funds from Tier 2 into Tier 1 only in consistent, predictable amounts that mirror your usual transfer history. Victor Okafor, 71, from Charlotte, North Carolina, implemented this 3-tier structure in January 2026 after his son, a banking compliance officer at Wells Fargo, warned him that his account had been internally flagged twice in 2025 for irregular deposit activity. Since restructuring, Victor has not received a single inquiry. His total assets did not change. His income did not change. His lifestyle did not change. The only thing that changed was the pattern, and the pattern is all the system monitors. I understand this sounds like considerable reorganization for something that may never affect you, and that is a reasonable reaction. Some financial advisors argue that the SAR system is so overwhelmed with filings, more than 4.6 million SARs were filed in 2024 alone, that the probability of any individual senior being investigated based solely on a SAR is relatively low. They are likely correct about the odds, but here's the counter-argument. The cost of prevention is one afternoon at your bank opening a secondary account. The cost of a CP 2000 notice, a document request, or a denied loan application is months of stress, potential accountant fees ranging from $800 to $3,000, and the permanent existence of a SAR on your FinCEN record that future lenders can access. The gap between the cost of prevention and the cost of consequences is what makes this worth your attention. One additional point, the updated advisory changed something that applies specifically to joint accounts. Before March 2026, SAR evaluations treated joint accounts as a single entity with a unified pattern. The updated guidance instructs banks to evaluate each account holder's contribution pattern independently when a joint account receives deposits from multiple sources. This means that if your spouse sells a piece of jewelry for $4,500 and deposits the proceeds into your joint checking account, that deposit is evaluated against your spouse's individual contribution pattern, not the account's overall pattern. If your spouse does not typically make deposits into that account, even a modest one-time deposit could appear anomalous when examined through that individual contributor lens. Shirley Benton, 75, from Sacramento, received $3,800 from her sister as partial repayment of a family loan. She deposited it into the joint account she shares with her husband. Her husband's pension and Social Security are the only regular deposits into that account. The $3,800 from an unrelated third party, Shirley's sister, created a SAR flag because the system identified an unfamiliar source depositing into an account with an established two-source pattern. Shirley did not discover this until 4 months later when her husband's mortgage refinance was delayed pending additional documentation. The connections between everything covered in this video are tighter than they appear on the surface. The SAR filing triggered by irregular deposits in your checking account can influence your DIF score, which can raise your audit probability, which can produce a CP 2000 notice requesting documentation you may have already discarded. And if you cannot produce documentation for a deposit, even a completely legitimate one, the IRS holds authority under IRC Section 6201 to assess tax on unexplained deposits as unreported income. That is the chain: irregular deposit to SAR to DIF score increase to CP 2000 to documentation request to potential tax assessment. Each individual link is defensible in isolation. Together, they form a pipeline that converts innocent activity into a tax liability for people who cannot prove what a deposit represented. Here is your action list. Monday, call your bank and ask which checking account options allow you to separate recurring income from irregular deposits without monthly maintenance fees. Use the phrase, "I would like to establish a predictable pattern for compliance purposes." That sentence communicates to the banker that you understand how the system functions, and compliance-aware customers consistently receive different treatment. Tuesday, review your last 6 months of checking account statements and identify every deposit that did not originate from Social Security, a pension, or an employer. Count them. If you had more than 3 non-recurring deposits in any single month, your account may already have been flagged for SAR review. Wednesday, if you are married and hold a joint account, determine whether both spouses deposit into it regularly or whether one spouse is the sole depositor. If only one spouse deposits regularly, any deposit from the other spouse or a third party is considerably more likely to appear anomalous. 3 questions to ask yourself before your next deposit. 1. Does this deposit come from a source that has previously deposited into this account? 2. Is this deposit within 30% of my average monthly deposit total? 3. If the IRS asked me to document this deposit's origin 18 months from now, could I produce a receipt, a canceled check, or a written record? If you can answer yes to all 3, proceed with the deposit without concern. If any answer is no, consider directing that deposit to a secondary account designated for irregular income and retain documentation in a folder labeled with the tax year and deposit date. Donald Yates, the man from Clearwater who opened this video, eventually resolved his CP 2000 notice. It required 3 months, 2 letters from his accountant, and a signed affidavit from the neighbor who purchased his fishing boat confirming the $6,200 transaction. The IRS accepted the documentation and closed the inquiry without assessment. Donald paid $1,100 in accountant fees to resolve a matter that a simple bill of sale kept in a file at the time of the deposit would have resolved at no cost. He told me he now keeps a folder beside his desk. Every time money arrives that is not Social Security or pension income, he writes 1 sentence on a sheet of paper: who paid him, how much, what it was for, and the date. That folder, he said, costs nothing but provides peace of mind worth thousands. In the next video, I am covering the 3 IRS letters that most commonly precede a bank-related inquiry: CP 2000, letter 2645-C, and notice 6174-A and precisely what each one means, what rights you hold upon receiving one, and the 30-day response window that most seniors overlook because the deadline is buried in paragraph 4 of a 6-page letter. That video releases Thursday. Your bank is not your adversary. The IRS is not your adversary. But the space between them, the automated system that monitors patterns, files reports, and initiates reviews without human judgment, that system does not know you are honest. It does not know you sold a boat. It does not know your sister repaid a loan. It only knows that the numbers move differently than they typically move. And when numbers move differently, the system does precisely what it was engineered to do. Your protection is not secrecy. It is structure.